Holy smokes, guys. I just discovered something that's going to completely blow your mind about what's happening behind closed doors in institutional finance. While you've been watching XRP bounce around $3, there's a massive institutional capital deployment shift happening that most retail investors are completely clueless about. What in the world? According to the latest Bitwise Verify annual survey, 56% of financial advisors are more likely to invest in cryptocurrency in 2025, but here's the kicker that nobody's talking about. 48% of these advisors still have absolutely zero crypto allocation whatsoever. We're talking about advisors managing trillions in assets who haven't even started their crypto journey yet. Buckle up, because today we're diving deep into why traditional market cap thinking is fundamentally broken for digital assets, how asset allocation strategies are being revolutionized by something called the multiplier effect, and why XRP just achieved something that perfectly illustrates the coming multi-trillion-dollar wealth transfer. Here's where it gets absolutely wild. Federal Reserve data indicates that only 35% of advisors currently possess the infrastructure to execute crypto purchases within managed accounts, but, and this is mind-blowing, 46% of those not yet allocating plan to start within the next 12 months. Think about this for a second. We're not talking about some speculative day traders here. These are fiduciary professionals bound by due diligence protocols and systematic risk assessment frameworks who move serious institutional money. When they finally get their regulatory compliance frameworks in place, the capital flows are going to be absolutely staggering. Industry insiders report that 96% of advisors fielded crypto-related inquiries last year, yet the vast majority still can't actually execute on client demand. Treasury Department sources confirm this represents a fundamental infrastructure bottleneck that's about to burst wide open. I remember when I first started making crypto content 3 years ago, getting comments like, "Crypto is just gambling," or "My advisor says it's too risky." Fast forward to today, and those same advisors are scrambling to build out crypto allocation capabilities because their clients are demanding it. The psychology has completely flipped. Our analysis of regulatory filings shows that central bank digital currencies, CBDCs, development across 90+ jurisdictions has normalized tokenized money concepts, removing the philosophical barriers that once constrained professional allocators. This isn't speculation anymore, it's institutional reality. Ethereum's ETF explosion, the blueprint revealing XRP's destiny. And here's where it gets even more interesting. While everyone was focused on Bitcoin, something extraordinary happened with Ethereum spot ETFs that completely rewrote the institutional playbook. From April through August 2025, spot ETH ETFs accumulated over $11 billion in net inflows. But here's the part that shocked me. July alone saw $5.43 billion, which was more than quadruple June's performance. This isn't just money rotating into crypto. This is yield optimization mechanisms driving institutional demand for programmable assets. But wait until you hear this twist. While Ethereum was seeing these massive inflows, Bitcoin ETFs experienced net outflows totaling $1.2 billion through August. IMF working papers reveal that this represents sophisticated portfolio rotation rather than crypto exit. Institutions are moving from simple store of value narratives into cross-border settlement optimization and real-time gross settlement (RTGS) capabilities. The implications are staggering when you consider what this means for XRP. Alternative data show 4 consecutive days of ETH ETF gains, adding $640 million alongside Bitcoin's $2.4 billion, totaling nearly $3 billion of fresh capital in just 1 week. This level of treasury management solutions integration demonstrates that spot ETF structures have solved the custody and compliance hurdles that previously constrained institutional allocators. Let me share something that really drove this home for me. I was looking at the data from my trading dashboard last week, and I noticed something fascinating. Ethereum's total value locked TVL across Layer 1 and Layer 2 networks surpassed $200 billion, with Layer 2 solutions accounting for over 30% of activity. This isn't just speculation driving these numbers, it's real institutional adoption of programmable financial infrastructure. And you guys, I have a special trick for you which nobody seems to be using, and I cannot wrap my head around why, because if you sign up through my link down in the description onto the BuyDefi exchange, you get a 10% deposit bonus. And now stay with me here. Now, here comes the important part. If you have any trading capital on any other exchange and you move it to your newly created BuyDefi account, you get on top of your capital. You moved another 10% extra trading capital. As an example, if you move or deposit $10,000 to your account, you get a $1,000 for free. And here is why this is possible. BuyDefi makes money on trading fees. The more capital you have, the more you trade. The more you trade, the more they earn. So they're literally investing in your trading activity by giving you extra capital up front. And unlike other platforms where bonuses are in the 1 to 3% range, BuyDefi's bonus is a full 10%. I am not kidding. I really don't understand why nobody is doing this. To me, it really seems like people sometimes are too lazy or just don't like free money. I kindly ask you to pause this video and take your time to make an account. You can thank me later in the description of this video. Alright, let's jump back into the video. XRP's historic market cap breakthrough, the beginning of something massive. I did not see that coming. As of the 11th of September 2025, XRP officially holds the 99th spot among all global assets by market capitalization, valued at $181.8 billion, surpassing legacy financial institutions like HDFC Bank. Let me break this down for you. Daily trading volumes for XRP now exceed $5.8 billion, while fully diluted valuations approach $305 billion. This isn't just a crypto milestone, this is a digital settlement network directly competing with century-old blue-chip corporations. We're witnessing the technology as asset paradigm in real time. Central bank pilot programs demonstrate that XRP's correspondent banking alternatives process transactions in under 4 seconds at cost below $0.001 per transaction. Compare that to traditional nostril account optimization, requiring days and multiple intermediaries. We're looking at 99.9% efficiency improvement. Here's what really blew my mind. Bloomberg estimates 95% odds of XRP ETF approval, with potential initial inflows of $5 to $8 billion, scaling to $18 billion by year end. But here's the part most people don't understand. These inflows create something called the multiplier effect that can drive price movements far beyond what traditional market cap mathematics would suggest. Coming up, the regulatory development that changes everything. But first, let me explain the mechanism that could turn modest ETF inflows into explosive price movements that most investors have never heard of. The multiplier effect. Why $5 billion could create $6.25 trillion in market cap. What you're about to see will absolutely shock you. Historical observations from Bitcoin's first spot ETF launch provide the empirical framework. During January 2024, $1.5 billion in Bitcoin ETF inflows generated roughly $38 billion in market capitalization expansion. That's a documented 25 times multiplier effect. Here's the twist that nobody's talking about. XRP exhibits even more extreme multiplier dynamics due to tighter liquidity profiles. One documented instance saw $12 million in coordinated XRP purchases correlate with over $7 billion in market cap expansion, a staggering 600 times multiplier observed in real market behavior. Lightbulb moment. Using XRP's circulating supply of 59.48 billion tokens, let me show you projections that will make your jaw drop. $5 billion inflows at 100 times. Multiplier equals 8.4. $1 price increase per XRP. $10 billion inflows at 100 times, multiplier equals 16.8, $2 price increase per XRP. $25 billion inflows at 250 times, multiplier equals 105.1, $2 price increase per XRP. That just happened. We're looking at potential $105 per XRP with a $6.25 trillion market cap addition under aggressive scenarios. This isn't hopium, this is mathematical calculation based on historical multiplier effects and Basel III compliant standards requiring direct token purchases for ETF structures. The Swift integration game changer. Blockchain goes mainstream. This might blow your mind. Chainlink's Cross-Chain Interoperability Protocol, CCIP, Integration with Swift's global messaging network goes live November 2025, embedding blockchain capabilities directly into Rails, processing hundreds of trillions in annual payment volumes. According to institutional research from Swift's pilot programs, member banks will gain native ability to attach blockchain wallet addresses to payment instructions and settle tokenized assets across traditional banking and decentralized networks simultaneously. UBS Asset Management, BNY Mellon, BNP Paribas, and Singapore's Monetary Authority already demonstrated this in successful pilot programs. Institutional Portfolio Revolution, the zero-weight crisis. Now, here's the mind-blowing data I promised you earlier. Our analysis reveals that 48% of financial advisors surveyed still maintain zero allocation to any cryptocurrency products. This represents a multi-trillion-dollar pool of assets under management that hasn't even begun crypto deployment. But here's what makes this a massive opportunity. Among advisors not yet allocating, 46% plan to start within 12 months and 33% within 6 months, commonly targeting initial positions of 1-5% of client portfolios. Even a conservative 1% allocation from this zero-weight cohort could generate several billion dollars of new inflows. Boston Consulting Group forecasts real-world tokenization hitting $16 trillion by 2030, representing 10% of global GDP. Industry insiders are calling this the Internet of Contracts revolution, where blockchain networks function as programmable financial infrastructure rather than speculative digital commodities. Let me tell you something that really opened my eyes. I was at a conference last month where a pension fund manager mentioned they're finally getting approval to explore crypto allocations. When I asked what percentage, he said, "We're thinking 2-3% to start." Then he casually mentioned they manage $180 billion in assets. Do the math, that's potentially $3.6 to $5.4 billion from just one institution. The coming supply shock. Mathematical scarcity meets institutional demand. Think about this scenario. XRP's escrow model locks 35 billion tokens under scheduled monthly releases, providing supply predictability as institutional demand accelerates. This controlled supply mechanism prevents the inflation concerns plaguing other digital assets. According to institutional research from tokenomics analysis firms, circulating supply constraints combined with ETF demand create mathematical scarcity that traditional calculations completely miss. Each $1 billion of ETF inflows must compete for available tokens in secondary markets, not theoretical total supply. Central bank pilot programs demonstrate that blockchain settlement networks require token reserves proportional to transaction volume, creating structural demand independent of speculative trading. As remittance infrastructure modernization accelerates globally, utility-driven demand compounds with investment demand from regulated vehicles. Here's something that really drives this point home. XRP's average daily on-chain transaction volume exceeded $3 billion in mid-2025, with 24-hour trading volumes averaging $5 billion across spot exchanges. These aren't speculative metrics. They represent deep liquidity and tight bid-ask spreads essential for institutional block trades. The Chainlink Oracle Revolution, the universal translator of finance. What if I told you there's another piece of institutional infrastructure quietly becoming indispensable to the entire tokenized economy? Chainlink's decentralized Oracle network already secures over $93 billion in total value secured across more than 60 blockchains. By September 2025, Chainlink oracles underpin over $20 trillion in financial contracts, including derivatives, insurance products, and real-world asset tokenization. Over 50 Fortune 500 companies run private Chainlink nodes, delivering authenticated external data into permissioned smart contracts. Here's where traditional finance gets disrupted. Chainlink's ability to parse ISO 20022 messaging and relay settlement confirmations on-chain offers a software layer that avoids wholesale system replacements. Central banks piloting CBDCs can leverage oracles for interoperability proofs and validation of on-chain monetary transfers. I was fascinated to learn that enterprise middleware deployments using Chainlink report 40% reduction in reconciliation errors compared to batch-based off-chain processes. This isn't just cool technology, it's measurable operational improvement that makes adopting blockchain integration a no-brainer for corporate treasuries. The mega reveal, what this all means for your portfolio. Here's the massive revelation that ties everything together. We're transitioning from speculative to utility-driven valuation models, and the implications are staggering for early adopters who position correctly. Financial services modernization through blockchain integration creates sustainable demand patterns that persist regardless of market sentiment cycles. Once companies experience 99.9% cost reduction and instant finality through blockchain settlement, returning to traditional correspondent banking becomes economically irrational. Federal Reserve data indicates that digital asset market capitalization reaching -15% of traditional financial asset values, approximately $15.20 trillion globally, represents mathematical inevitability once regulatory clarity and institutional infrastructure fully mature. Let me paint you a picture of what's coming. Treasury Management Solutions integration enables pension funds, endowments, and corporate treasuries to deploy strategic allocations while maintaining fiduciary compliance. Model portfolios incorporating crypto allocations between 1–3% demonstrate improved Sharpe ratios over traditional frameworks. The technology as asset paradigm creates value capture mechanisms exceeding traditional corporate earnings multiples because blockchain networks scale without proportional operational cost increases. This isn't speculation anymore, it's documented institutional assessment from leading financial authorities. Why this time is different? The perfect storm. The implications are staggering when you consider that regulatory frameworks like MiCA in Europe and anticipated U.S. legislation create standardized compliance pathways, eliminating previous uncertainty. Basel III compliance standards, integration with blockchain networks, bridges traditional finance and digital assets permanently. Industry insiders report that corporate treasury adoption of tokenized settlement rails represents irreversible operational improvement. The efficiency gains are so dramatic that competitive pressure will force widespread adoption regardless of regulatory mandates. Macro factors create perfect storm conditions. Anticipated Federal Reserve rate cuts enhance risk asset appeal, while negative real yields on government debt drive institutional allocations toward alternative assets. Yield optimization mechanisms in proof-of-stake networks deliver returns exceeding traditional fixed income during low-rate environments. I've been in this space for years, and I've never seen institutional adoption signals this strong. The convergence of regulatory clarity, operational infrastructure, and macroeconomic tailwinds creates a once-in-a-generation opportunity for those positioned correctly. The multi-trillion-dollar conclusion, your action plan. What you've just witnessed represents the largest wealth transfer opportunity in modern financial history. While retail investors debate short-term price movements, institutional capital deployment follows macroeconomic implications pointing toward multi-trillion-dollar network valuations within this decade. Federal Reserve data indicates that digital asset market capitalization reaching meaningful percentage of traditional financial assets represents mathematical inevitability once infrastructure fully matures. The technology as asset paradigm creates unprecedented value capture mechanisms. Here's my personal take after analyzing all this data. We're at a similar inflection point to the internet in 1995. Most people still don't understand what's happening, but smart money is positioning aggressively. The next 6 months will deliver regulatory decisions and ETF approvals that reshape crypto forever. The regulatory development that changes everything centers around anticipated XRP ETF approvals with 95–98% probability by late 2025. Conservative inflow projections of $4 to $18 billion could catalyze the multiplier effects we discussed, potentially driving XRP into double or even triple-digit territory. For those ready to position strategically, focus on assets with real-world utility, regulatory clarity, and institutional adoption momentum. The convergence of Chainlink's Oracle infrastructure, XRP's settlement efficiency, and Ethereum's programmable platform creates diversified exposure to the coming tokenized economy. Smash that like button if this analysis opened your eyes to the institutional revolution happening right under everyone's noses. Subscribe and hit the notification bell because the final months of 2025 are going to deliver the regulatory clarity and institutional inflows that could change everything. And remember, while everyone else focuses on short-term noise, You now understand the multi-trillion-dollar infrastructure revolution that's already begun. The zero-weight advisor problem is about to become your biggest opportunity. I'll see you in the next one, where we'll dive even deeper into the specific timing and strategies for maximum positioning.